boiled frogs. I think we should use the boiled frogs and jump into our first article, the Yardi Matrix. Kind of reframed their supply expectation for the years of 2026, 2027, and 2028, talking about being speculative. But the storyline really across 25 was that we're going to hit this supply cliff. I mean, a very sharp, steep drop off in deliveries of multifamily assets, really in the back half of 25 and all the way across 2026. Yardi Matrix released a updated report to their supply forecast last week on January 5th that increased their overall forecast for completions in 26 by 6.4%. And in 27, it jumped by 8.1%. And then all the way in 2028, it rose 8.9%. I don't think those are small numbers relative to the overall general supply across the United States. But I do think it is interesting that the story for really the last 12 months has been this big, sharp, steep, observable, palpable drop-off in overall deliveries in the multifamily asset class. But here we are at the start of 26, and we're saying, wait, we were wrong. We're off by 6.4%. There's actually increasing supply, relative to that initial idea of this cliff. I think it's just kind of we're watching supply. You and I have talked about it on here for months on end about how the supply cliff it's more of a metaphor, and it's not really as steep of a cliff as we think it is. It's definitely a curtailing and a pullback. But it was interesting to see that Yardi Matrix went back and revised their overall forecast by 6.4% in overall completions for this year.
Yeah, there are a lot of investors, a lot of developers and owners that have been talking about, like you said, this supply falling off a cliff, and that's not happening. We should probably remove that language from we don't say it, but other folks.
Right.
Supply is not falling off a cliff. Now it is declining materially, to pre-pandemic levels. That is 100% true. There has been a big slowdown in construction activity. And deliveries are slowing down to a much, healthier pace. But there's not going to be that reversion to the mean of where we would have below trend growth or below pre-pandemic deliveries for a period of time. That would kind of get us back to a net normal over a multiple period of years. And that's good probably for the America's housing market. It's good for renters that there's going to be the supply and rents aren't going to absolutely spike up, which while investors we might like that spike, it actually can create just volatility in the market. And again, I'll take rent growth where we can get it, but I think just more sustained positive rent growth is healthier for just probably the overall industry, probably. The other just comment on this report is that, and I don't think they necessarily go into it in detail in the report. Griffin, correct me if I'm wrong, but it's the geographic, the divergence of some of this supply, the where the supply is coming online is still where it has come online, where there's really a glut and an oversupply. Mm-hmm. That is still where the new supply is coming online.
Correct.
So it's not as though everyone built apartments in Austin over the last several years and it's oversupplied, and now we're building apartments in Indianapolis or Columbus, Ohio, or St. Louis or wherever.
Right. They've just
we have oversupplied in Austin, and now we're going to continue to build apartments in Austin.
Yes.
And markets like Indianapolis, Kansas City, others are getting they had above trend supply, but not insane amounts. Definitely multi-decade peaks of new supply, but absorbable supply.
Right.
Many of those markets are going now to sub pre-pandemic pipelines, and will probably recover to kind of just a normal to a normalized level. But it's many of these markets that, again, are just already oversupplied are going to see just a continued level of supply. So it's, it's not survive until 2025. It's, continue to, I don't know, get a robust vessel for the next decade and strap in for, a true operating period, but also not, a period of I think, opportunity. But it's the show, it's the challenges have changed. Where previously it was, interest rate challenges, debt service was increasing. All these people were on floating rate loans, and so they're, good demand, rent growth was good, but your debt service, doubled what you thought it was. That story is less and less. Any new deals have rates baked in, and people have either recapitalized, refinance for the most part, and there's capital out there, so that's why we haven't seen all the distress related to loan maturities. But now the challenge is growing the rent roll, growing revenue. In many of these markets, they've been negative for going on 2 or 3 years, and it doesn't appear there is much reprieve. So we're going to see a dynamic where there will be continued rental declines in markets like Austin and Denver, and some softness everywhere else. But the everywhere else will recover a little bit quicker because we just don't have the onslaught of supply. And many of those markets didn't see really any negative rent growth. Maybe it was flat, but will pick up a little bit quicker. And so when you look at the compounding of rent growth over a period of time, you're going to see some big wins in some markets that are a little underappreciated, or they have been historically.
Right, not those mainstay headline markets that we're seeing that are drastically oversupplied.
Yeah, and that are all flashing green in terms of demographic. Like, again, Austin, there's a reason why people are building apartments in Austin. It's because people are moving to Austin. The reason why people are moving to Austin is because the jobs are moving to Austin. There's quality of life, it's politics, it's all of these reasons. But so many investors were like, hey, everyone's moving to Austin, let's all build in Austin. And again, if making up numbers, if 1 million people move to Austin, that's great. I might want to build apartments, but if we build 2 million apartments, well, maybe we've built too many apartments. So again, it's a great case study for capitalism and little freer markets of kind of bringing prices down. And I know it's being touted, politically for those reasons of like, look, here's a market that's a let people build. Rents are actually declining because the solution is supply. It's not, new restrictions or, even incentives. It's just literally let them build because there's demand, and that's going to bring down those prices. So it's fascinating to watch.